Welcome to Talk Tickers. Today we're digging into Alliant Energy's third quarter earnings call. That's ticker LNT.
On the surface, Alliant's quarter looked like a miss, but the stock actually ticked up. So what's going on? We're going to explain the real story the market was trading on, and trust me, it's a big one. All right, let's get right into the numbers. As you can see, ongoing earnings per share came in at $1.12. That was about 5% below what Wall Street was looking for. Revenue? A bit of a mixed bag. So yeah, on paper, this doesn't exactly look like a quarter to write home about.
But here's the thing. Investors completely looked past that headline miss. So why would they do that?
Well, because management immediately pivoted the conversation to a much larger and, frankly, a way more compelling story about future growth.
It all boils down to this one number, 3 gigawatts. To put that in perspective for you, that is a massive amount of new power demand that Alliant has already locked in with contracts from data center giants like QTS and Google.
And the impact of those 3 gigawatts is just staggering. We're talking about a projected 50% increase in Alliant's peak electricity demand by 2030. For a utility company, that kind of growth is almost unheard of. It's a real game changer. Now, to deliver that much power, you need to invest heavily, right? And that's exactly why management rolled out a new, massive 4-year capital expenditure plan to the tune of $13.4 billion.
CEO Lisa Barton framed this whole strategy as the Alliant Energy Advantage. The idea is essentially turning their service territory in Iowa and Wisconsin into a plug-in-ready hub for the digital economy, having sites prepped with land, fiber, and transmission access.
This new $13.4 billion plan is a huge step up, a 17% increase from their previous plan, as you can see, and all this spending is designed to grow their rate base, that's the value of the assets they can earn a return on, by a really powerful 12% annually through 2029. So the big question is, how are they paying for all of this? Well, it's a three-pronged approach. Cash from their own operations, issuing some new debt, and raising about $2.4 billion in new stock through 2029. And, it was a smart move. Management already locked in the price for the stock they'll need in 2026, which takes a bit of uncertainty off the table. This investment is the foundation for their new financial guidance. They're projecting about 6.6% EPS growth for next year and establishing a new long-term growth rate of at least 7%. But here's the real kicker. Management hinted that there's significant upside since they're already in active talks for an additional 2 to 4 gigawatts of projects. Wow. It's so important to understand that Alliant's story isn't happening in a vacuum. It's part of a massive industry trend. We're in what's being called a utility capex supercycle. Companies all across the board are spending billions to meet the incredible power demand from data centers and AI. This tells us the growth wave is real, and it looks like it's here to stay. This brings us to our final take. What we've seen is an earnings miss that, weirdly enough, revealed this powerful, long-term growth story that the market absolutely cheered. So, what's the call on the stock from here?
We rate the stock outperform, and frankly, we expect the next quarter's numbers to pretty much be secondary. The real focus for everyone is going to be on any news related to converting that 2 to 4 gigawatt pipeline of new data center projects into firm contracts. As the market gets more confident that this 7% plus long-term growth rate is not only achievable, but actually has upside, we see the stock re-rating higher. The growth story is real, and the market is just beginning to price it in.
This is not financial advice.